This is episode 47 of the More Doors podcast. We are here on an amazing Thursday afternoon. I'm here with my very handsome, very intelligent co-host, Nick Good, and we have an amazing guest, Mr. Kiyoshi Simon, who's going to dazzle us with his knowledge about building an amazing multifamily portfolio and a lot about tax compliance. We're going to be right back with Kiyoshi and some wisdom from Mr. Good right after this. All right, everybody, welcome back. Number 47, man. We are slowly creeping up on episode 50 or 50 for our Spanish listeners out there. We are super excited about a lot of stuff we have going on. We are down one today. Mr. Brian Force is sailing with his family off the coast of Alaska as we speak. Supposedly, he's going to ride an orca before he gets back. Supposedly. That's what he said. I don't know if he's got the balls for it, but we'll find out. What's up, Nick?
What's going on, buddy?
What are you up to?
Oh, just a little bit of this and a little bit of that.
Yeah.
Still trying to sell, dispo a major asset, which we're really close on. So I'm excited about that one and be able to free up some time and capital to devote more into our Deep Blue partnership.
Ooh, don't talk dirty to me, buddy.
Yeah, you know I know what you like there. So now I'm excited about having our guest on, Kiyoshi, today. But before I introduce him, because first off, he's got what, 350 million under management.
That's what he. Yeah,
that's what he said.
That's what he says. He's like super accomplished, and like that's not even.
And I don't.
He does a lot of other stuff too.
I don't think he would embellish because he's a CPA, and we know that CPAs don't embellish anything. So 350 million under management. Today's show, we're going to talk about tax strategies and the benefits of investing in multifamily real estate. So we're going to go over that, maybe some recent tax changes that are coming or maybe coming down the pipe. But look, before we get into that, Matt, we've got to thank our sponsors.
You know, your voice inflections here are compelling. Keep going.
I love it. Keep it going, Matt. So we got to thank our sponsors today, Deep Blue Capital. They're the one that sponsors this show. That's the partnership that Matt, Brian, and are in. And look, we just closed on a storage facility that is starting to hum along.
Absolutely.
Yeah, we're getting our bearings on that one, as well as a Garland, Texas apartment complex. I was just in Garland earlier looking at a single family property. And I'm going to tell you that our apartment complex looks a lot better than that house. So I'm super the competition out there for us is not very high. So we're going to be raising rents and returning great capital on that one. So look, if you want to learn about investing in some projects that we have, we're underwriting a lot of deals right now. Maybe you've got some money lying around. You need some tax benefits. You want to get some passive income. Then you need to go over to deepbluere.com. Just sign up there, get on our investor newsletter. We have an ebook that Brian Force wrote, and we've got some soon-to-be released white papers that Matt has authored. So you'll definitely want to get signed up on there. So don't miss out on that. And then if you're an aspiring multifamily, maybe a syndicator investor, maybe in the commercial real estate business, or you've got a business of your own that you want to get marketed correctly, you want to get that right exposure, then you need to come here to Tor Studios. Jesse Showalter, like Buchalski will say, he's got the best beard in the game. So you want to come take a look at it. He'll let you touch it if you sign up for some shows. So just go over to torstudios.com and tell him that the guys from the More Doors podcast sent you. So with that, let's bring on Kiyoshi.
Let's do it.
Kiyoshi, welcome to our show, sir.
Hey, guys. Thanks for having me. Excited to be here.
Absolutely. You probably have never heard of an intro like this before in any other podcast.
Love the energy.
Yes. And with that energy, one thing I did leave out is before we get into Kiyoshi's bio, and I'm going to want you to give us that 60,000 foot overview of who you are. You know, where did you come up? You know, your education, you know, why did you become a CPA? But before we get into that, go leave us a 5-star review on Spotify. Go over to our show, Deep Blue RE, on YouTube. Hit that subscribe button, as well as any podcast channel that you're consuming this on, and leave us reviews, please, because that's how we're able to get more great guests like Kiyoshi. But Kiyoshi, you have 350 million under management, and tell us a little bit about who you are, the company. Why did you become a CPA? Give us all the goods.
Yeah, absolutely. So my name is Kiyoshi Simon. I am a managing partner of Vertical Street Ventures, a private equity firm, and Vertical CPA, a real estate specialized tax firm. I myself am also a real estate investor. I started in the passive arena, and slowly as my portfolio built, I started to transition more into the active space. And with that, there came new opportunities. Specifically, what we found is that there's so many great opportunities in the tax field that you can leverage to help enhance and compound some of your growth, even early on in your portfolio. And over time, those kind of things can compound to create some really great results.
Love that.
Yeah. And so take us a little bit further back. What, when you were getting, going through education, did you always want to do something in finance? Did you always want to become in the, accounting CPA world?
Yeah, great question. So I got my undergrad at UCLA. I got my master's at Cal State Fullerton. Really the appeal for me, I was investing at an early age. I was reading 10Ks and I was investing in the stock market, and I was going through all the financial reports. And I read this quote by Warren Buffett that really stuck with me. And he said, if you want to understand business, you have to go into accounting. Accounting is the language of business. And so I said, okay, I want to go into business. Therefore, I need to go into accounting. And once I was in the accounting world, I realized how powerful of a tool taxes were. They tend to be one of the largest expenses on our P&L. We just don't see it. And so that was the area I really wanted to focus my time and attention.
I love that. And if I could go back in time, I wish I would have done that. Going through school, I'm like, I don't want to do accounting. This is what the nerds do. And I said that with all due respect because I was a football jock, and I'm like, yeah, well, I would love to put that. I mean, have you seen what they get paid? I would definitely be buying more assets with us.
True story.
But if I could go back in time, and people that are listening to this is that I agree 100% with that. And that quote by Warren of looking at the financials and understanding that, because I was on a quick little side note. I was on another syndicator's pitch deck last night, and it was short, didn't give enough information, didn't talk about the business side of this, and only talked about too much of the upside, not in the downside. And so, I would think that number one, Kiyoshi, like having someone of your caliber as a CPA and your tax strategies background and being able to really look thoroughly through and the understanding, I mean, that's massive for you guys in your partnership. Would you agree?
Oh, absolutely. When we're underwriting properties, we're going through adding our due diligence in, and then we're doing stress tests, right? You always want to look at the upside, but you want to plan for the downside. And all of that comes down to the numbers and the models. And, some of that stuff can get a little bit heavy, but it's so critical to long-term success.
Speaking of models, this is something that the team relies on me to do. Do you guys use a model that you've built on your own, or do you use one of the, kind of large consumption models that are floating around out there?
Yeah, so a couple of years ago, we started with one of those large consumption models, and they're generally kind of the same thing. They're pretty good, but what we found over time is we wanted something that was a little bit more detailed to, again, help run those different model case scenarios. And so we actually brought in our own consultant, and we developed our own underwriting tool, which is available for some of our investors and academy students.
Nice.
And so sorry, like, I'm going back through everything here. And one of my questions here is because, a lot of the people that we have on they've studied their way into this, and the education level that you have, Simon, is just massive. I mean, just going through the studying and the testing for being a CPA is a lot. I have a cousin who's gone through it. I definitely wouldn't want to go through that today. How did you get into the real estate investment? You said that at a young age you were reading the 10Ks and investing in the stock market. How did you transition that into real estate and then getting into the multifamily part of it and then the tax planning?
Yeah, great question. If I can go back a number of years, I grew up pretty humbly, for lack of a better word. And when I found myself in college, I had to support myself through college. I worked 3 jobs. And the great thing about that is it helped develop a really great work ethic. And I learned to live off very little. And so if I had about $400 in my bank account, I was happy. Everything else I invested in the stock market. And because every dollar was so precious, I made sure to do my research. I looked at the companies, and I invested. Now, it wasn't very long before I realized that, while Coca-Cola is a great company, I have no influence over Coca-Cola, and that bothered me. One of the things I love about real estate, it's a tangible fixed asset that I can reach out and touch. If I want to force appreciation, I can do that, right? I can change that fact pattern of that asset. And so coming out of college, I liquidated the portfolio. I bought my first property with my girlfriend, now wife. And we actually house hacked. And that really started kind of that ball rolling, right? And as you start to, enjoy passive income and you start to see the benefits, both on the financial as well as the tax side, it's infectious. I don't know about you. I got bit. And from there, it was just, hey, let's keep doing more of this and more of this and more of this. And we kind of expanded our single family portfolio and then eventually started to get more interested in multifamily so that we could leverage off of volume.
I love that. I love that. So, one of the things that I was thinking about as you said that is you're not the first guest, right, that has told us they've gotten started with a house hack, right? Mm-hmm. I think Zach, right, told us that 20 episodes or so ago. And it's unbelievable how, you think about the concept of house hacking or buying a home with a low down payment just to kind of get in, right? Or some creative financing. And it's amazing how many people start the journey like that and then just go through the roof, as opposed to some folks kind of fighting the limiting beliefs about taking that next step and always, looking at it from the sidelines or just remaining a passive investor. And I love how those, just common skills and common strategies ultimately break the ice for people to just go big over time. Can we
kind of expand on that, Matt? And Kiyoshi, how old were you and your wife, if you don't mind me asking, when you bought your first house and was house hacking?
Early 20s. So like I said, we did it right out of college. Part of that thesis was that I knew if we bought our own place and we lived in it just us, it would be really hard to go from that to kind of a shared living situation. Mm-hmm. And so we had roommates in college. And so let's just kind of keep that same model. But now instead of us paying the landlord, I'm going to be the landlord. And it worked out really well for us. You do give up a little bit of privacy at home, but frankly, we were so busy and we were doing so many things out of the house. House was really just a place to sleep. And again, let's turn that into a capital generating asset, which we did.
Yeah. And now did you buy that property while you were living in California?
Yep. Yes, we did.
But Kiyoshi, real estate in all the real estate in California is so expensive and I can't get anything to pencil. How did you do it?
Yeah, that's a great question. That comes up a lot. What I will say is it is harder to find deals in California, certainly. But there are good deals out there, right? It's just if you're willing to work and look and do that due diligence. And this property penciled for us. It kind of met all of our metrics. I did kind of take into account some of the tax benefits, which were certainly compelling, right? We have a tenant who's not only paying a portion of our mortgage, but we're also getting all of the tax benefits from that real property asset. And so that's kind of an unknown benefit that really helped propel us as well. So all those things kind of came together. And I hear all the time there's a lot of concern about, California tenants and all of that. And we've certainly taken our lumps. But what we found is just it all comes down to due diligence, right? We have a very thorough vetting process for our tenants so that when we place a tenant, we're not placing them for that year. We know that we have a long-term relationship with them. And most of our tenants have been in our properties for over 5 years at this point.
That's amazing. That's amazing. So one other thing that I wanted to just poke at before we tie the ribbon on this subject is, you touched on, you have a tenant that's paying you rent, you're getting all the tax benefits. The theory for house hacking to get started, right, is that after a year, after a certain amount of time, you have enough equity or you saved enough money to put a tenant into the unit that you had, and then you go buy a single family residence or another house hack, right? I think what a lot of people forget and don't take into account is the income that you have, that you're generating from your tenant or tenants once you've backfilled. That all counts as gross income when you go apply for your next loan. So if you play your cards right, you're gonna qualify for a bigger property on the second or third or however many downstream, right?
Absolutely. And I think, to my earlier points, all about doing the due diligence and setting yourself up for success, not kind of in the moment, but really doing everything from a strategic and intentional perspective, right? So when we bought that house, we had everything set up. We knew what we needed to track. We kind of knew what our numbers looked like so that in 5 years, when we executed that refinance, you know, it was an easy home run for our lender because we had everything in place.
Amazing. Well, and again, you know, as I listen to all of this, is even today, Matt, you kind of made a, you know, you're being, you know, facetious about, you know, not penciling because prices are too high in California. That's what everyone says now, whether it's here in Texas or really any of the other states. And it's more about the sacrifice than anything, that young people right now are not wanting to buy a home because they're saying it's too expensive or interest rates are too high. They're not making enough money. And really what you did, Kiyoshi, and what others like Zach did on the show when they come in and house hack, it's sacrificing and saying, hey, realistically, I can't afford this on my own, or my wife and I, my partner and I can't afford this just you know, with our income. But we can have some friends rent out a room. We can sacrifice not having our private space as much. And with that small sacrifice can snowball into something if done correctly, of then in 3, 4, 5 years, that property's worth, you know, significantly more. You sell that tax-free, right? Kiyoshi, I'm not a CPA, but, you know, homesteaded properties, that's going to be a tax-free, you know, assuming you're not making more than $500,000 net on it, that's going to be a tax-free gain that you can then go put into another property and then start building your net worth through your primary residence. Is that correct?
That's correct. You're stealing my thunder, though.
Well, I need some airtime for me a little bit too. Matt and Brian usually steal my thunder here. So, but I really want that to be a point for the younger generation, because Brian and I, who's not here, who's riding that humpback whale or orca, whatever he's doing, he, you know, we own residential sales teams, and that's something we hear all the time, Kiyoshi, is like, it's too expensive, it's too expensive, and it's too expensive. And the first part to owning more doors, which is the theme of this podcast, is getting one door. Right. And you know, everyone typically starts, the journey is owning single family real estate. And then they're like, oh, I want to scale this because I want to retire, or I want this to become my full-time job. And then the next step is learning the multifamily game, because it's a lot faster. You can scale faster once you understand that that's more of a business ran operation than just owning real estate in itself. So, Kiyoshi, like, take us through your next steps into, all right, you and your wife house hacked this one. You know, what were the next steps to now, you know, being a managing partner with 350 million under asset?
Yeah, so effectively, as we started to build out the single family portfolio, and single family is great. I don't have any knocks against it, but we did find that, you know, naturally there's a little bit of a ceiling that you start to encounter. And so we started to look more at multifamily so we could take advantage of volume. And really, to be a stronger player in the multifamily place, I knew that we had to buy, you know, a larger apartment complex, right? And usually that involves, you know, JVing it or finding some partners, things like that. So I would go to meetups and I would talk with a ton of people and just, hey, see what their interest was like. And over time, I ended up finding 3 individuals who would eventually become my partners in Vertical Street today. And we were all like-minded individuals. And at the time, we were all still working. But we were very passionate about multifamily real estate. And so we started this company, and we just, we worked hard, right? We had our 9 to 5s, and then we had, as I like to say, our 5 to 9, which was the company. And that slowly grew, and it got traction until it had enough traction where, hey, we had to make a choice. Do we want to stay at my job, which was great, or do I want to fully lean into this endeavor? And, you know, I took the leap and fully leaned in.
Nice. Well, let's actually, before we shift over to Kiyoshi, the tax advisor, like, what markets do you invest in? Let's clue the listeners in on that.
Yeah. So most of our single families are located in the Southern California area, which is where I'm located as well, right? We wanted assets that were close and we could check on them and, you know, really actively manage those properties. As we transitioned into multifamily real estate, and really with vertical, our assets, our multifamily assets, are all located in the Arizona market, Tucson and Phoenix specifically. And with those assets, you know, I'm a general partner, and so we actively manage those properties as well. And so that's been a really great opportunity to start taking advantage of leverage, which is something that I'd love to talk about a little bit later, but also taking advantage of other people's strengths, right? I'm not a single operator anymore. I have partners, we have teams under us who are really good at what they do, and they execute to everyone's joint success.
Love that. So you're clearly a very intelligent guy, right? Why, of anywhere in the U.S. that you could have bought multifamily properties in, did you choose Tucson and Phoenix?
Yeah, great question. Number of reasons. So one of the things we always look for is strong job growth, right? There are a number of large companies and employers moving out to the Arizona market, right? So that's always really positive. We also notice that if you start looking at the trends, there's already a strong trend of upward rent growth to kind of support some of our underwriting at the higher rental levels. The other great thing about Arizona is compared to California, much stronger and landlord-friendly laws, right? So it's much easier to do an eviction if you need to in an Arizona market versus a California. We also love that the geography is, for the most part, you don't have earthquakes, you don't have tornadoes, floods, any of that stuff. And so that's always great from an insurance perspective. And of course, predictable expenses, right? So property taxes rise at a fixed rate year on year, which means we can underwrite that with confidence and we don't have any surprises. And so all of these factors kind of come together to make Arizona, in our minds at least, a compelling market.
Nice. Yeah, you talked about taxes and insurance there, and I think those two things alone are putting a lot of pressure on operators across the country. I mean, specifically in Texas, we woke up in 2023, and all of a sudden Texas was like, "Hey, COVID's over. We're going to reassess the crap out of your property," and I mean, they were just coming in with some gnarly valuations that put the squeeze on a lot of people.
Mine went up 41% in 1 year.
Wow.
With taxes and insurance. And it was nothing I could do about it. I had to just say, thank you for not going higher. So, so Kiyoshi, what do you see, number one, I know a lot of California investors investing in the Arizona market. I want to go a little bit in some of the tax strategies because, right now, raising capital, and again, I was on this pitch last night, and the reason being is that they're struggling. This group is struggling to raise capital for a Class A asset here in Texas, and just wanted some feedback of what they could do better, et cetera. And the group is saying, man, this is the hardest time to raise capital. But what we have found here at Deep Blue is that providing great opportunities, and then talking about some of the tangible benefits, like the tax strategy benefits for accredited high net worth investors. So what are some common deductions for real estate investors, and what are you seeing potentially changing here in the future that would be either an advantage or disadvantage for future investors?
Yeah, so I'll take that in two parts. I think in terms of deductions for real estate investors, right? We tend to think of all the direct costs associated with an investment. One of the things that we find more often than not is investors tend to forget about all their indirect expenses, right? If they're using due diligence software, if they're using a laptop or computer or iPhone, or I'm going to a networking event and I travel there and I book a hotel and I go to this great meetup event. All those items are also tax deductible, but tend not to be remembered because they're not directly related to a certain asset or investment. So I would say that's kind of the first thing. Of course, depreciation always is part of the conversation. And, one of the things that always kind of burns me a little bit is, hey, if you have a passive investor, sometimes they'll get bad advice and their CPAs will say, hey, you don't get any benefit from depreciation in your investment because you're a passive investor. And that's just not always true. And so I think the education component is really powerful for real estate investors. As well as just setting up good systems and processes to start tracking all of their expenses related to those investments so that they can really get their maximum dollar value out of their investments. And then in part two, really in terms of upcoming changes, that's kind of a hot topic right now. The Tax Cuts and Jobs Act was enacted a few years ago. Under Donald Trump, and some of those provisions are going to be sunsetting in the next few years. And so the landscape within the tax environment is going to change. If Trump is reelected, potentially those could be extended or potentially not. And so there's just a lot of variables right now in the air. Another topic I would say that comes to mind is bonus depreciation. I know there's a lot of discussion right now about potentially bonus depreciation going back up to 100% right now in 2024. Under the current regulations, it's at 60%. But there's some legislation to bring it up to 100%. The president has signaled that he would sign a bill that stated as such, but right now it's caught, for lack of a better word, in the Senate. And has been for a number of months. And so that's another hot item that we kind of have our eyes on. And if it does end up going through, it's a great tax planning opportunity for a lot of investors and clients out there.
Can you just for, you know, the people that are using this podcast, and hopefully they are, to educate themselves on tax benefits and strategies, what is actually bonus depreciation? What does that mean?
Yeah. So when you buy an asset, you are able to recognize an expense related to that asset. So if I buy a building for $100,000, instead of taking a $100,000 deduction, I basically recognize that expense over a number of years, 27 and a half, right? And so I ratably recognize a portion of it. Now, the benefit is that there's certain strategies that I can implement to break down that asset into faster depreciating assets. So things like furniture, fixture, certain land improvements, things like that. And on those assets, rather than having to wait, 15 years to recognize the full benefit, I can recognize, right now 60% of that cost expenditure in the first year, right? And accelerate my depreciation pretty dramatically.
Are you also, so from that, over that, you accelerate that first 60%, do you still get the other 40% over the next coming years, or is it a one-time use?
It's kind of right now you would take the first 60%, and then of the other 40% that would get recognized over, in that example, the 15 years. And so, it's it can get a little bit more complicated, of course, but that's kind of the general concept. But from an investment perspective, it's hugely advantageous because I don't need to wait 15 years to recognize that expense benefit, right? I'm getting the vast majority in the first few years. And those accelerated deductions are going to lower my taxable income, which means I have more dollars in my pocket to reinvest, right? And so I'm investing more capital at an earlier point in time, which allows me to take advantage of time and compounding investments, which is incredibly powerful.
I love that. That's fantastic. So you were mentioning before about some of the deductions on due diligence tools, systems, software, stuff like that. Like, how do you know as I think a caveman like me is a GP, right? Like, what's deductible and what's not? What should I think about presenting to my accountant as a potential deduction for my real estate business, and what is just completely out of hand?
Yeah, another great question. So the conversation that I like to have with clients is twofold. One, the rules are anything that's ordinary and necessary for your business, right? And so that kind of helps set kind of a rough standard, right? So what is ordinary and necessary, right? Is the software program to do the due diligence required, right? And generally the answer is going to be yes. But of course, there's all those other expenses that are a little bit in that gray area. And so what I tell clients is, you know what? Let's set up the systems to capture those potential deductions. Let's put them onto your P&L schedule. And then what we do on our end is we'll go through and review all those and see how we can kind of move things to A, optimize your deductions, and then B, make sure that we're not taking a deduction on anything that you probably shouldn't be. And so it's really a partnership between clients and operators, as well as their CPA tax advisors.
Let me ask you this question on that is what are some, and I'm going to make this a long question. I feel like Brian now because I'm really making really long, drawn out questions. But what are some questions that we should be asking our CPA when we're interviewing them, and what should we look for? And the reason why I ask is we just had an investor invest in a project of ours, the Haley, and this investor owns several Airbnbs and he self-manages them. And I was like, look, I'm not a CPA, check with your guy, but you should qualify as enough hours in self-managing from a real estate professional side to be able to possibly take that immediate upfront K1 loss. And his CPA said he doesn't. Now, I've heard from others that is not true when you're because it's not a third-party management. That person is all self-managing. So what I've quickly discovered is not all CPAs are created equal. And understanding how to help you, save money.
Yeah, great question. I love it. What I will say is that, when people identify as a real estate CPA, ask the follow-up questions. What does that really mean, right? And what most people tend to ask is, do you have other real estate investor clients? And most other CPAs or practitioners do, right? But it could also just be a passive investor with 1K1. That would technically count. And so that's not quite as productive of a question. What I always like to recommend that people ask is, do you yourself invest in real estate? That's a great starting question, right? Because if I'm going to work with somebody, I want to know that they understand my business inside and out, right? Investing in real estate is a big opportunity. It's something that we sacrifice and put a lot of time and effort for. So I want to make sure that the person I'm working with to maximize my tax deductions and savings also knows the lingo. They also know what they're doing. And so I always ask them to tell me about their real estate investment experience. You know, what kind of assets do they hold? What's their investment strategy look like? You know, and I always like to use the metaphor of a skydiving instructor, right? Like if my skydiving instructor has never jumped out of a plane, like I don't want to work with them, right? Period. And so it's really critical that you're working with professionals who have that relevant experience. You know, going past that, you know, ask all those relevant questions, right? So can you tell me about a cost segregation study? You know, what exactly is bonus depreciation? What's the difference between bonus depreciation and accelerated depreciation, right? And, you know, just asking those questions, you can tell if they're experienced or not, right? If you're getting yeah, you know, that's a great question. Let me get back to you, right? That doesn't instill a lot of confidence in me versus someone who can give me a really thorough explanation of, hey, here's what a cost segregation study does, right? Here's why it's beneficial for you, right? We can take bonus depreciation under, you know, code section 168 sub K, right? Like those are the kind of details that tell me like, oh, I'm dealing with somebody who actually knows what they're talking about. And then I have confidence that my tax structure, savings, and opportunities are with the right professional.
Amazing. So one of the questions that I'm hoping you can help us answer on the show, Kiyoshi, is we have a lot of investors and we've had a lot of guests, right, that are either working at a W-2 and investing in real estate, mostly passively, right, or folks that have been able to leave their W-2 because of how their portfolios performed, and now they're doing real estate full time. Let's take the earlier bucket and talk about. So, you know, we have a number of accredited investors that continue to have W-2s. They're investing money into our deals. We've generated returns for them. How are those returns treated differently than the income they would generate from their W-2, especially when you layer in some of the tax benefits like cost seg and other sort of real estate related tax deductions?
Yeah, another great question. So what I'll say is when you go out and you're working your W-2 and you're getting paid, that income is what's called ordinary income, and it's subject to the highest tax rates, right? As high as 37%, and then depending on your fact pattern, it can actually go a little bit higher. Versus when I invest in real estate, not only am I taking advantage of all these great tax strategies such as depreciation planning, cost segregation studies, energy efficiency studies are another new topic that I think not enough people are talking about. But all of those things allow me to shelter my income and shelter my cash flow so that I have a income producing asset, but on paper, I'm showing a loss, which means I'm not paying any tax on those dollars. And so the parallel I always like to make is, you know, if I make $100,000 from my W-2 net of taxes, I'm taking home, I don't know, maybe 60% of that, you know, depending on state taxes, potentially even less. Versus with that real estate investment, where it's cash flowing $100,000, if I'm working with the right professional and I have the right strategies in place, I'm taking home $100,000. And so, you know, not all dollars are created the same, not all income or deductions are created the same. And so I think real estate gives you a great vehicle to take advantage of some of these great opportunities in the tax code.
Okay. So there's something that, you know, I learned after filing like my first K-1 8 years ago, right? And that is that when you earn passive income from real estate, right, you can only write off so much, right? Between expenses, cost seg, so on and so forth. Check me on that if that even sounds remotely accurate. Go ahead.
I guess I would want to ask some more questions, but you know, there can be some limitations. You know, if you're a passive investor, there's certain limits on passive income that can come into play. That also, so that could be maybe something that happened. There's also what's called an excess business loss. That's probably a really big one that I would say. You know, I have a lot of clients who, you know, we have one spouse who's a high income earner, And then what we'll do is we'll structure so that their spouse is a real estate professional. And that's really, really powerful. And so they can use the losses from real estate to offset their high income earning spouse's income, which is really taxpayer favorable because they're usually paying at the highest effective rates on that ordinary income. Now with that said, this excess business loss limitation limits the amount of losses that we can allocate, net losses that we can allocate to that other spouse's W-2. It was paused during COVID, and kind of post-COVID, it was renewed, and I think caught a lot of people off guard. I know during COVID, I was having that conversation with my clients and saying, hey, once we get out of this, we got to just kind of plan for this thing because it's a significant potential limit for some clients.
What would be the expected difference between, let's assume, married, filing jointly, one of the two spouses is a high income earner, the other's not so much, right? And when you then layer in the real estate tax professional qualification of the same couple where one's a high income earner, the other's a real estate professional, and you can take that and apply it towards tax treatment for the married entity, if you will.
Yeah, for high income earners, it's typically 37% and upward, right? And kind of the easy math on that is, if I'm making $100,000 investment, I'm getting $100,000 of losses on that investment, I can apply my effective 37% tax rate, and I've saved $37,000, which is really powerful, right? Because effectively what has happened is you've taken a $100,000 equity position in an investment for $63,000, right? And so that's really, really powerful versus for non-real estate professionals, those kind of benefits are a little bit more spread out and they're not quite as apparent.
Now, can those deductions, the difference in those deductions, can that be applied to ordinary income or just passive investment income from real estate investments?
For real estate professionals, the activity from real property trades and business is considered non-passive. And so at that point, those losses can be used to offset other forms of income, inclusive of W-2 income. Again, with that excess business loss limitation, there's a pretty high limit. It's, I think, $550,000 right now to that amount. But generally speaking, yes, I can start using those non-passive losses against other forms of income, which is incredibly beneficial.
Can't wait till I get married next year.
There you go.
Dude, last year I got crushed. The year before wasn't easy either.
There's some benefits to being married for sure. That's right. 100%. Could be the only reason. I don't know.
No, it's definitely
you're right.
Not the others.
Yeah, still in that honeymoon phase. Kiyoshi, I want to kind of move into more of the operator role. You mentioned there's two things that you mentioned that you'd like to touch on, and I took note of that. I said, yeah, you said, kind of explaining the leverage piece here, and then, you're no longer a single operator. Can you touch on the leverage, and then why is it beneficial that you're no longer just a single operator? You're working within a group here. What makes that better?
Yeah. So in terms of the first question, leverage is such a powerful aspect of real estate. One of the questions I get fairly often is, why should I invest in real estate if it's a lower rate of return relative to the stock market, right? And there's a number of reasons there, right? We can talk about the ability to control the asset or influence the appreciation of the asset and force appreciation on the asset, right? But the other really strong aspect that a lot of people don't think about is how leverage plays into those two, right? So if I have $100,000 and I invest $100,000 in the stock market and I get a 10% rate of return, I'm walking away with $10,000. But the beautiful thing about real estate is I can take that $100,000, I can leverage, put down, 20%, I can buy a $500,000 asset. And if I get the same rate of return, that 10%, well, I'm walking away with 50,000 instead of 10,000, right? I can even have 8% and I'm still walking away with a larger amount of net cash flow versus securities, right? In addition, that mortgage is, I'm paying interest expense on it, right? And I have all these deductions to actually lower my taxable income as well. And so again, I look at kind of my net tax cash flow because at the end of the day, what really matters is how much money am I actually walking away with? And when you take all those things into consideration, by virtue of leverage and some other factors, I just think real estate is such a great investment vehicle for building wealth.
And just to clear something up for our listeners, what's the difference in tax treatment on the 10% that you would earn buying you know, an index fund or investing in the S&P 500 or Nvidia or whatever, versus the tax benefits that you would get from investing in a multifamily opportunity as a passive investor?
Yeah, so stocks, securities, mutual funds, ETFs, all of those are subject to what's called capital gain treatment, which is anywhere from 0 to 20%. For most people, it tends to be around 15 to 20%. And then depending on your income, actually, once you cross 250,000, you also have it's called the NIT tax, or the net investment income tax, which is another 3.8%. So effectively, let's say 24% at the highest rate. Versus, again, with real estate, I can leverage all of those great tax opportunities using leverage, using bonus depreciation, cost segregation studies, expensing assets, and even structuring to kind of create a nice environment to foster deductions. And so on that $50,000, right, I can shelter most, if not all, of that taxable income, so that I'm walking away with full 50,000, right, at effectively a 0% rate, right? And that'll kind of dilute over time. But then on the back end, when I sell, right, I'm going to be paying long-term capital gain rates. I do have depreciation recapture. There's some ways to mitigate that. But again, from a timing perspective, I'd rather pay that, 30 years in the future versus now.
Sure. Yeah. And that's what one of the things, Nick, I think we got to really, double tap on at some point in the future is, we have a lot of folks that, compare returns from multifamily versus what they can earn in the stock market or whatever, right? But when you can 1030, if you do very well and you have any sort of gains in a multifamily deal, real estate deal, and you can 1031 those proceeds into another deal and then run the same play with a cost seg study and the other types of tax deductions, you're not going to get that treatment buying Amazon, right? Or buying Nvidia. And so it's right. Definitely apples and oranges. And I think a lot of folks out there they're like, well, it's an investment, right? It's the same thing. Well, it's vastly different.
Yeah. I just sold stock. I just sold some stock 2 days ago and bought a house all cash rental property. And the only reason I did it was the deal was a good deal. And I'm going to go and depreciate everything so I can try to offset the sale of the stock, hopefully all of it. And then when rates come down to 5%, I'll do a mini cash out refinance, pull about 150,000 out, have a low leverage on it, and then go buy another property and then stack some of those single families as well. So, but most people probably don't have that, and you can't 1031 that, that option in there, and they probably don't even have, anything that they're looking at buying to do that.
Yep. Agreed. So we're coming up on time here, Kiyoshi. You want to be considerate of our time here. Give us, the top 3 takeaways that you think our listeners can put into action as a result of our chat here and your experience on both sides of the CPA and the investment side.
Yeah, great question. Again, I think it all comes down to finding the right professional, right? Nobody does it alone. And I think the CPA is a really integral part of anyone's wealth building strategy and success. One of the big things for us is that we don't just work, for our clients, we work with our clients, right? We form partnerships with our clients because we're also invested in their success. And that kind of cadence and relationship, I think is pretty unique, to be honest, with us versus other operators. But I think it's really important, right? You want to make sure that your financial future and your tax future is in the right hands. So I would say, number 1, find the right professional. Number 2, set yourself up for success, right? And so your professional is only going to be as good as some of the information that you give them, right? And so setting up good systems and processes to make sure that you're capturing all of your deductions, overhead, indirect, et cetera, I think is a really key opportunity, as well as doing the tax planning with your CPA, right? Sitting down with them, and instead of saying, hey, this is what I did last year, please help me. Saying, okay, this is what I want to do, right? I want to sell my stock and I want to go and buy a new property. And I'm thinking about doing a cost segregation study or maybe an EE study. Like, let's kind of talk about that, because then we're being proactive versus reactive. And there's a world of difference there, right? And so from a planning perspective, there's a lot of great things that you can do with your CPA, and they can provide guidance to you. And then on your end, execute on it, right? In tandem with that professional. And number 3, somewhat gallantly, I would say, connect with me on Instagram, or schedule a consulting appointment. You can find us on Instagram at The Real Estate Tax Guy. And you can find our firm at vsvcpa.com. And for any listeners, just mention the More Doors podcast, and we're happy to do a free initial discovery call to just talk about you, your tax matters, and how we can help take you to that next level.
Love it. Love it. And we're going to have that in the show notes and everything else, because here's what, if you're like me, Matt, I don't know if you're like me on this, but, something that I get so mushy brained and so fatigued thinking about, look, how to save on taxes. That's a full-time job. And we all know that taxes is the biggest theft of wealth. And just hearing Kiyoshi, I'm like, all right, I want to sign up for that, because, I have an amazing CPA team. One thing that I have to do better and proactive is sit with them, because I'm a lot of times I'm reactive on this, and probably I would say the majority of the population is just reactive when it comes to their taxes. They just take their lumps. They're like, you know what, Kiyoshi, it is what it is. I'm just going to take my licking and probably never going to invest again, because it sucks to have to pay all that taxes and all that other crap. And then they don't do anything with it. And so I would highly, highly suggest that anybody listening to this, go sign up for that free consultation, because, I'm trying to buy a house right now, and the lenders don't like my tax returns, because on paper, it shows that I'm losing like 20 grand a month. And then they're like, I can see all the money you have in your account, but we don't want to lend on that. So, then we look at a different loan type. So, Mortgage Mike, who's doing my loan, is like, who's your tax professionals? I need them. And that's probably what they say about you, Kiyoshi.
Yeah, I certainly get those calls, and I work with the lenders to really help them understand what they're looking at and some of the strategies there. But yeah, there's some great stuff that you can do if you work in tandem with the lenders. Perfect.
Well, I think we need to have him back on after November 5th of this year, which is
after the election.
After the election, because that could be, usually right after election is when we start trying to predict what happens with tax change and tax reform. So we should have him. I mean, that's a Tuesday. We record the show on a Thursday. I think we need to commit to having Kiyoshi back on November 7th, and he gives all his guaranteed predictions on what's going to happen tax-wise, and we'll put it on him as CPA genius.
I love it.
Amen.
We just definitely have Kiyoshi back on.
Yeah.
Absolutely. What were we going to say, Kiyoshi?
No, I just said amen.
Oh, okay. I said, hey, Matt. Sorry.
Yeah.
My left ear is deaf at this point. Well, Kiyoshi, it's been great having you on. I love this conversation. Yeah, I think we managed to make, discussions on tax pretty fun. And actually, I think I'm going to do that too. I'll find some time on your calendar, Kiyoshi, and get connected with you on this, because I have a lot of stuff kind of going on and in my head about taxes. But if all our listeners out there, go find time with Kiyoshi, take advantage of that free consultation. Kiyoshi, definitely appreciate the time, and best of luck in all your endeavors, specifically on the real estate side. So thanks for joining on the show.
Awesome. Thanks for having me, guys. It's been a pleasure.
Yeah. Well, and as you're signing up for that free consult, make sure that you go over to Spotify, you go over to any podcast listening device that you're on, leave us a 5-star review. Make sure that you go and smash that subscribe button, as the New Yorker Buchalski would say over there. Just smash it. And that way you subscribe to our YouTube channel there at Deep Blue RE. And then you got to support our sponsors, Deep Blue RE. So the Deep Blue team here, which is myself, Matt, and Brian, who is bringing deals out, some great opportunity for our investors and future investors. So make sure to go to deepbluere.com and sign up for that. Get on our investor news list, sign up for our ebook and the white papers that's going to be released here shortly. And then you need to have a show. Everyone needs to have a podcast, even if you're talking about knitting.
How do you have a podcast about knitting?
Brian could have one.
He's sewing.
And sewing and knitting is kind of the same thing.
I don't think Brian would be the best to have a knitting podcast, because he sews shit upside down.
It's dyslexic knitting
it's
and
called
sewing.
How to Do Things Wrong When You Knit.
Yes.
By Brian Force.
Exactly. But you know who could shoot it? Tour Studios. Go to tourstudios.com. Get with Jesse Showalter, the best beard in the business. Like I said, you go sign up and get and do some shows with him. He'll let you rub that beard.
Hashtag beard butter.
That's right. So get with Jesse Showalter, Tour Studios. Check out Kiyoshi. You're going to want to sign up for that free consult. And look, stop letting the government steal your money. Let Kiyoshi earn that money and save you some.
Rather give it to Kiyoshi than Uncle Sam.
I'd say F, yeah.
Yeah. Awesome. Thanks, Kiyoshi. Thanks, Nick.
All right, guys.
All right. Thanks, everybody.
Take care.
Yep.